Good afternoon, everyone, and welcome to London Health Sciences Foundation's Estate and Tax Planning webinar. Thank you so much for joining us today and for your continued support of our hospital and the patients and families cared for in our community. I'm Kathy Papineau-Thornhill, Manager of Legacy and Memorial Giving, and I'm delighted to be with you today. Legacy Giving plays an important role in supporting the vital work of LHSC through funding innovative equipment, groundbreaking research, and exemplary patient care. A number of First in Canada initiatives have been supported by visionary legacy donors and their thoughtful estate planning. With November being Make-A-Will Month, we thought this would be a great opportunity to raise awareness about the importance of having a will and a solid estate plan. Today, our industry experts will share some helpful tips on estate planning where you can maximize tax savings and reduce estate administration fees. As Canadians, we are fortunate to have generous tax incentives. With careful planning, you can ensure your family and loved ones are cared for and support the future of healthcare in our communities. A few notes for this afternoon. First, everyone is muted to protect the sound during our presentation. And second, we will be doing a question and answer session at the end of all the presentations today. So at any time during the various presentations, if you have any questions, please feel free to go down to the bottom of your screen and put your question into the chat box. And we'll do our best to answer all of them at the end of today's webinar. We're going to begin with our first presenter, Terry Zavitz, who is the president and founder of Zavitz Insurance and Wealth, a specialty company founded 40 years ago in the field of life and living benefits insurance, as well as group benefits. As a certified financial planner and trust and estate planner, she considers her clients' current retirement and estate picture in making recommendations to improve their financial situation. She has long been an advocate of gift planning that allows a donor to maximize their philanthropy. And now I'd like to welcome Terry, who is broadcasting from her office.
Well, thank you, Kathy, and hello, everyone. It's great to be here and work with you today or speak with you today. I'll just share my screen. Whenever we do estate planning, that often includes a discussion as to your favorite charities and how to leave a purposeful gift to these charities when you pass, and also a lot of times during your lifetime. And these gifts are put together in a way that provides a larger gift than you ever thought possible, and one that can have more impact than you ever thought possible. To make it a win-win situation, the Tax Act allows for generous tax credits when you make such a gift. And I refer to these gifts as planned gifts because the gift is truly planned as to how it comes together, and you as the donor gets to decide how that gift is used within the charity. So let's look at three opportunities: the gift of life insurance, the gift of appreciated shares, which includes mutual funds and segregated funds, and that of donating your RRSP to or a RIF to your favorite charity. So let's just figure out how to turn the screen to the next slide. There we go. My disclaimer, basically just see your advisor about anything I talk to you about, as there are unique situations and no one gift type or rule applies to everybody the same. So option one is the gift of life insurance. And again, with the gift of life insurance, you can make a larger gift than you ever thought possible for a very low premium. So with the gift of life insurance, there's three ways to give life insurance that I'll talk about. One is where you take out a policy and you name the charity as the owner and the beneficiary. And you pay a premium, and you can pay that premium monthly, quarterly, or annually. And at the end of the year, the charity gives you a receipt for the premium paid. That gives you a tax credit. And after the tax credit is provided, the cost of the insurance is much less. At the time of death, the death benefit is paid to the charity totally tax-free. So let's take a look at an example of John and Kay, age 62 and 60. They make regular contributions to their favorite charity, and they want to leave a significant gift upon the last of their deaths, in lieu of the annual gift that can no longer be possible. So they talk to their life insurance advisor and apply for a joint last to die permanent life insurance policy with an increasing death benefit. This death benefit starts out at $100,000. Premium is $2,500 a year, and on and after the tax credit is provided, it actually turns out to be under $1,500 a year. By the time they pass away in 30 years, that death benefit has grown to $150,000, which is a 7% after-tax rate of return. Not too bad. It enables John and Kay to provide a substantial gift to the charity, receive a tax receipt for it, and the charity gets the full $150,000 when they pass away. I will say that the $150,000 that passes to the charity is not subject to a receipt. And the reason for that is that the receipt came in the form of premiums being paid. There's a second way of donating life insurance to a charity. And that is where you take out a policy naming the charity as the beneficiary directly, not necessarily as the owner, that can happen, but you can name the policy beneficiary as the charity, or you can do this within the will. There's no receipt that is given for the premium that is paid along the way. But when you pass, the life insurance passes through the estate and to the charity, and the estate or your last tax return can use the charitable receipt up to 100% of taxable income to lower your taxes. So in this case, you don't get a receipt for the premiums paid, but your estate gets a credit for the death benefit. And there's a third way that you can give a life insurance policy, and that's where you donate an existing life insurance policy to a charity that you no longer require. You receive a charitable receipt for what's called the fair market value of the policy, and you get that during your lifetime. And if you pay any ongoing premiums, that too is subject to a charitable tax credit. The insurance benefit at death is paid directly to the charity tax-free. You've already got your tax receipts during your lifetime, so there's no further tax receipt. So let's take the example of Jane, age 50. She owns a $250,000 life insurance policy that's totally paid for. There's no reason to pay any more premiums. She no longer needs it, so she wants to donate it to her favorite charity. She goes to an actuary and to obtain the fair market value of that policy, which is $85,000. So she then gets a receipt, a charitable receipt for the $85,000, and it can be applied up to 75% of her taxable income in the year that she made the donation, or move it forward for the next 5 years. So a significant tax receipt for a benefit that is no longer required, and at time of her passing, the charity gets the full amount of the money. So let's look at another possible gift. You can provide a significant gift using your RRSP or RIF. John passes away, he's age 80, and his tax bracket is 46%. He has a RIF worth $500,000. Now, if he was to do nothing, the taxes owing on that RIF would be $230,000, providing that he does not have a living spouse. So if this RIF that's remaining and he doesn't have a spouse, that all becomes taxable to the estate, and the taxes owing of $230,000. However, if he makes the beneficiary of that RIF or RSP, RIF in this case, the charity, then the estate gets a receipt that they can use as a tax credit against the taxes owing. And so at the end of the day, there's no taxes that have to be paid, and the charity receives the full $500,000 benefit from the RIF. Now let's look at the third way that you can provide a gift that you never thought possible. And that's with the donation of appreciable assets such as stocks, segregated funds, or mutual funds, just as an example. And I put this chart together to exemplify how a gift of securities, appreciated securities, can be a win-win situation for you and the charity. So in our first example, we have securities worth $90,000. And let's say that the cost of the shares were $50,000. So that means if that potential donor cashed in those shares, there'd be a capital gain of $40,000. And the taxable portion of that $40,000 is $20,000. And depending on the tax bracket, in this case, we've got it at 40%. There is tax that's owing on that money. And then at the end of the day, the charity gets $80,800. And the tax savings from that $80,000 is $37,000. Now, what has the government done to make it easier to donate shares and appreciable assets? That is that they don't charge tax on the capital gains if you donate that appreciated security directly to the charity. You don't cash it in, you donate it directly. So the $90,000 is donated to the appreciated shares of $90,000 is donated to the charity. The $50,000 the $40,000 that is taxable, there's no taxable gain on that. And so you get a much larger tax receipt and save much more tax, and the charity gets the full $90,000. So if we look at that, what was costing tax a lot more tax at the end of the day, the charity getting much less, and in the second scenario, getting a whole lot more. A great way to make a gift to charity. And with that, I'm going to pass it back to Kathy. It was good talking with you today.
Thank you very much, Terry. That was very informative and great tips indeed. Coming up next, we have Diane Wood as our presenter. Diane is a partner in the Canadian tax practice of KPMG's London office. Her principal activities are serving middle market enterprise clients, including healthcare professionals, concentrating on personal income tax planning and compliance, personal financial planning, and estates and trust planning. Her skills include personal tax consulting, personal tax compliance, wealth, gift and inheritance tax planning, trust and estate tax services, succession planning, and family business. And now I would like to welcome Diane.
Thank you, Kathy. So I am going to talk today a little bit more with respect to the income tax implications. Terry mentioned some of them, but I wanted to speak, before I speak about the income tax implications of some of the donations that are in one's will. I wanted to first speak a little bit about the timeline for income tax filings of an estate and how long it might take for an estate trustee to be able to actually close out an individual's estate. It's a question that I get asked quite frequently. So generally speaking, a terminal tax return, or the final personal income tax return for an individual, is required to be filed by the earlier of April 30th of the year following the year of death and 6 months after the date of death. So if an individual were to pass away between November 1st and December 31st of the year, the deadline in that case would be 6 months after the date of death. I should note, however, that if an individual is self-employed and has self-employment income on their tax return, the normal filing due date for their personal tax return would be June 15th rather than April 30th. The terminal tax return is normally assessed fairly quickly because we electronically file these returns. However, in some cases, there's an opportunity for trustee to file an optional tax return for the year of death. However, those returns have to be paper filed, and CRA tends to take much longer to assess those returns. In looking then at the estate year end, the initial year end of the estate can really extend up to the anniversary of the date of death. So in effect, 365 days from the individual's date of death. The estate tax return will report any income, etc., that is earned between the date of death and the date of the estate year end, and is due 90 days after the estate year end. In terms of the assessing time frame for a tax return for an estate, we've been finding that this year CRA is taking 6 months or longer to assess most trust returns this year. And this is quite a bit longer than even a year ago when we were finding they were taking 3 to 4 months. And the reason being is that in many cases, estate tax returns are not able to be electronically filed. So it's an individual at CRA that is in fact dealing with the assessment. So once the administration of an estate is complete, the trustees can then select a date, which they would be called the wind-up date, for the estate. Depending upon the complexity of the estate, it could be there could be a requirement to file more than one estate tax return. But once the final estate tax return to the wind-up date is completed, filed with CRA, and CRA issues the final notices of assessment, then the estate trustee can apply for a clearance certificate for the estate. The CRA timeframe for issuance of clearance certificates, based on what they were considering their process standards from a couple of years ago, they were indicating that a clearance request would be issued in about 120 days for simple estates, and it would be longer for complex estates. So it could be more than 2 years from the time of the individual's death until such time as a clearance certificate has been received. With all of the various filings and then waiting for assessments from CRA, etc. So let's move on and speak a little bit then about charitable bequests. Prior to 2016, donations were deemed to have been made by the individual immediately prior to their death if they were provided for in the individual's will. However, since the legislative changes became effective January 1st, 2016, donations are no longer considered to be made until the actual payment is made to the charity. Thus, now the individual is considered to be made by the individual's estate, and the donation must be reported on the estate income tax return. If the trustee of the estate then so chooses, the donation can be carried back and used on the terminal return of the deceased individual or the immediately prior year's tax return. Now, CRA has an administrative policy with respect to claiming of donation receipts. So, as noted, the donation that's provided for in the will or through named beneficiary designations are now deemed to be made by the estate. However, CRA will provide that as long as the donation is made in certain circumstances prior to the filing of the terminal tax return and the donation receipt is received, then the trustee of the estate can in fact claim the donation at the time that the terminal tax return is in fact filed. If, however, you're in a scenario where the donation receipt is not available when you file the terminal tax return, CRA then indicates that they will still permit, in certain circumstances, the ability to claim that donation on the terminal tax return when it's initially filed, as long as the trustee provides uh, the information that's noted on the slide: a copy of the will, a letter from the estates to the charitable organization advising of the donation, along with a description of the property being gifted and its estimated value. They also have to provide a letter from the organization acknowledging the gift and noting that it will be accepted. And then a statement indicating that the charity or that the estate is in fact a graduated rate estate at the time that the donation is in fact made. Terry spoke a little bit about charitable bequests of registered accounts, such as RSPs and RIFs. These assets, as Terry noted, are very highly taxed on death, since 100% of the fair market value of these assets on the last to die of the spouses is fully taxable on their final tax return. As such, in the province of Ontario, if the individual is in the top marginal income tax rate in the year, they will pay income tax of 53.53% on the value of that RIF or RSP on death. As I noted previously, CRA's administrative policy is to permit that a donation be made by the estate and claimed on the terminal tax return when it is filed in certain circumstances where the donation has been made and the donation receipt already received prior to filing the terminal tax return. Direct beneficiary designations of items such as life insurance, RIFs, and RSPs, they can often be dealt with much more quickly than other assets in the estate, since generally speaking, there is no requirement to receive probate before making this particular gift. As such, when a charity is the designated beneficiary of such an asset, it's much more likely that the donation can be made and the donation receipt received prior to actually filing the terminal tax return. So this ensures that the resulting tax benefit is received immediately at the time that the tax return is in fact filed. It should be noted that if an individual is in the top marginal tax bracket in Ontario and they are making a donation of part or all of their RSP or RIF to charity, the value of that donation receipt would be 50.4%. So as I noted, the tax rate, top marginal tax rate on that RIF or RSP income is 53.5%. The charitable donation credit is 50.4% in Ontario. So there's a very small amount of income tax that is not covered off by the donation receipt. So the slide here just demonstrates the returns that a donation can be claimed on if the estate qualifies as a graduated rate estate or former graduated rate estate. As long as the estate qualifies as a graduated rate estate or former graduated rate estate at the time the donation is made to charity, there is a lot of flexibility on when the donation and what returns the donation can be claimed on. It can be claimed on the final return of the deceased individual, the tax return for the year prior to death. It can be claimed in the estate in the year of the gift, up to 75% of the net income. or in prior years. So and then any remaining balance that cannot be used can be carried forward into the future. So there's a lot of flexibility in being able to claim and what returns you claim a donation on, as long as the estate is in fact and does in fact qualify as a graduated rate estate. So the next item I just wanted to speak a little bit more to is gifts in kind. And gifts in kind in that I'm going to speak about specifically are the publicly traded securities, segregated funds, mutual funds, etc. Just really following up on a bit of the discussion that Terry reviewed. So in general, where the individual has held marketable securities, seg funds, etc., as at the date of death, and they intend to subsequently donate those particular shares to a charity, the tax implications result in initially a deemed disposition of the securities at fair market value on the terminal tax return of the individual. And then there will be a subsequent disposition by the estate at the fair market value on the date the gift of shares is actually made. So there can be some change in values between the date of death and the date the actual donation is made. So in an example, to the extent that the fair market value of the securities to be donated decreases in value between the date of death and the date of the donation, there will be a capital loss triggered in the estate. And if that donation is made within the first taxation year of the estate and the estate qualifies as a graduated rate estate, that loss can be carried back to the terminal return to, in effect, offset the capital gains on the deceased terminal tax return. The deceased terminal tax return can then, in fact, they can claim the value of the donation that was made based on the charitable donation receipt provided at the date that the gift was made. To the extent that the fair market value of the property happened to increase in value between the date of death and the date of the donation, there will be a capital gain realized that can be fully sheltered by the donation credit. Again, the charity issues a donation receipt equal to the fair market value of the donated securities at the time that the gift is received. As noted earlier, if the donation is able to be made prior to filing the terminal income tax return, then the donation receipt can be claimed on the terminal tax return when it's initially filed. And in that case, the income inclusion on the terminal tax return on that capital gain would be zero because it's a gift of shares to charity. If the donation is not able to be made until after the filing of the terminal tax return, perhaps due to time being required to receive probate for the estate, the terminal return would report the entire capital gain on the security based on the value prior to death. Once the donation is actually made, the terminal return would be amended to reflect that the securities were donated to charity, so that there's no capital gain ultimately on that terminal return, and the value of the donation would be claimed on the terminal return and could be used to offset both the capital gain and other potential income on that return. As a result of the income tax changes in 2016, the tax rules related to charitable bequests have become a bit more complex, but they've also provided some additional flexibility in some circumstances. At this point, I would like to welcome back Kathy.
Thank you so much, Diane. That was very detailed tax information and great tips. Thank you. Just a reminder to everyone, please write your questions in the question and answer box at the bottom of your screen. And again, we'll be answering them live at the end of our presentations. Our last presenter today is Susan Carlisle. Susan is the managing partner of Carlisle Peterson Lawyers, founded in 1990. A small boutique practice of 9 lawyers, Susan's practice is primarily solicitors' work in the areas of real estate, estate planning, and administration. She has extensive experience in complex estate planning and values the importance of including philanthropy while working with her clients to optimize their goals. And now I would like to invite Sue.
There we go, I think. Hi, Kathy. I am following 2 very deep dives that you've got from Terry and Diane, and going back to basics here about what estate planning is and what we're trying to do, usually by meeting with a lawyer to prepare documents. And so we start with when you're alive, why you would need these documents. The first one is to deal with future incapacity. And to have somebody make decisions about you by the person you choose to do it, to avoid publicity, if possible, to reduce probate fees and to do some tax planning, which we've heard in depth about just a minute ago, and if possible, to creditor-proof your estate. That's usually for self-employed entrepreneurs that we're mostly worried about, to make sure that the structures they've started in their life will continued after their deaths. The avoid publicity one, a lot of people are curious about, and I thought I might spend a minute here. There's a really wonderful thing you can do if you're nosy, which is to Google famous dead people's wills. And you can read things like Princess Diana's wills and Clark Gable's wills. So wills, once they're probated, are public documents and anybody can read them. So some people don't want people to know who they love or where they want their money to go or how much money they've got. So sometimes we get together to discuss what we can do to reduce the publicity factor in the will planning or the estate planning. When you're dead, what we're trying to do is make sure what you've got gets to the person or entities you want to have receive them, minimize taxes, reduce probate fees, and again, avoid publicity. So how do we do that? We've got a number of tools. The first document, I would suggest the first 2, though they seem pretty ordinary, are often for a lot of people the most important, which is the power of attorney for property and the power of attorney for personal care. So the power of attorney for property is a document that is valid the moment you sign it. Most people aren't aware of that. Once you sign it, you have delegated somebody to be your attorney for property. They can call and ask for that document from the lawyer who has it, and the lawyer must give it to them because there's somebody you picked. If you don't want that, if you only want it to be used in certain circumstances, such as you're out of the country or you're legally incapable, or you've told the lawyer that it can be released, then you have to be very clear in the instructions. The other document, a power of attorney for personal care, allows people to make health care and life care decisions for you, such as what type of medical treatment is appropriate, whether you're going into a nursing home, a long-term care, or care is being provided at home. You can be very detailed in what kind of care is important to you in that document. It typically also contains what we used to call living will provisions that say if you're terminally ill, what exactly you want to have done. That document is only used if you are incapable of making decisions on your own. The other documents we prepare are wills. We often do multiple wills to avoid probate because some assets do not require probate, most notably shares in private corporations and what we call real estate that was in registry that's been converted to land titles that can avoid probate by what's called a first dealing exception. We also draft trusts. Now, trusts are complex and expensive, and going back to the previous presentations, require tax returns to be prepared separately from yourself And so a lot of people, though there's a lot of advantages to trusts, don't want to spend the time or the expense of maintaining them. We also have designated beneficiaries. I'm sure you're all very well aware that you can be the beneficiary of your RSP, your RIF, your life insurance, and your tax-free savings account. So I think your tax-free savings account falls under successor holder. But it's basically the same thing. When you die, the asset goes directly to the beneficiary. I don't love designating beneficiaries other than spouses, because most of my clients, I find, want their children treated equally. And if one of their children die, they want it to go to the deceased child's family, either spouse or kids. And if you name beneficiaries of life insurance policies or RIFs or tax-free savings account, they're the children, and one of those children predeceased you, then what happens is it gets divided instead of by 4 by the 3 surviving kids. And though you might think your children will share with your grandchildren of your deceased child, it's not guaranteed. And it also might mean that if they do it, it's an informal trust, and the children or the grandchildren might get money too early. So if you are thinking about designating beneficiaries of those assets, I would suggest you speak with your lawyer and designate the beneficiaries correctly to ensure that it matches what your provisions would be if you will. The designated beneficiaries do have the advantage that the money comes quickly to your beneficiaries. Sorry about that. The other thing to keep in mind is that if you're designating your registered money to your beneficiaries that are not your spouse, the tax still has to be paid by your estate. And so if you have one child that's like mine, more inclined to spend more than they make, they might not have the money to pay the tax at the end of the year, and there might not be enough in the estate for all the kids to be treated fairly. So the 2 that are savers might be unfavorably, they might have to come up with some extra cash, is what I'm trying to say there. So you have to be very careful about designating beneficiaries, especially with registered funds. And then joint ownership of assets. So, the typical house that's owned by a husband and wife are jointly held and automatically goes to the survivor on death. We get a lot of calls from people that I think are much too young to ask this, to put the house into the name of their adult child, and children and themselves. And I don't recommend that for a variety of reasons. The most notable one being that you're not sure the tax consequences to the kids will be. It's possible that CRA would look at that as an informal trust and not tax the children on the gain. But right now your house is tax-free on death, and any gain is tax-free. But if you put the kids' names on there, it's not their principal residence, they then have to pay tax, or they may have to pay tax as well. If they go bankrupt, it'll affect your assets, and there's other negative consequences that you need to think about. It said in my introduction that I like doing charitable requests by will, and I do. I strongly recommend the RSP or RIF donation, because the tax is just so onerous when both spouses have died. I have had a number of files this year where I have written, I think the highest I wrote was $780,000, where I was the executor, and the RIF, the RSP, a woman was diagnosed with cancer, died very quickly, never got the benefit of that money, and did not want to leave it to charity. But $780,000 was the tax bill on the RSP amount, and it's shocking when you can make a big gift to a charity by leaving registered money or funds equal to registered money to the charity. You can also leave specific amounts. You can say, for example, I want to leave $100,000 to a charity of your choice, or you can leave a percentage. You can say, of my estate, I want X percent to go to the charities, and you can have more than one charity. And you can also leave the rest to your other family members, so you can divide up what you want. Most planned gifts are bequests made in will. There is a charitable receipt, which is we've talked about earlier. It is important when you're making a charitable bequest and you have a particular desire for how it's to be used, to do two things. One is you should always contact the charity and make sure you get its name right. The lawyer should include a clause in the will that says if the charity changes its name, then the gift follows the change of name. And if in fact the charity no longer exists, the executors are to find a similar charity. But you should also talk about what program or what goal you have for the use of the money. I call a lot of charities before as I'm drafting wills, asking, this is what my client wants. Can we draft the words? I don't give the client's name out unless the client has asked that their name be given out. Most people I find don't want to do that, at least in the initial instance. And we can go back and forth and make sure the wording meets the client's need and it's within the charity's mandate. For example, it probably wouldn't be a good idea to name the Humane Society of a charity designed to help people in the hospital beds. I don't think anybody would do that, but you need to make sure it's within the mandate. What do I see? I see no wills. And if there is no will, there's a lot of inadvertent consequences that people are unaware of. There is a statute called the Succession Law Reform Act that provides what happens when you die without a will, and it divides up your assets in a straightforward way. But what most people, and especially again going back to my children's generation, are unaware of is that married spouses and common law spouses are treated very differently in death. Common law spouses have no rights to the deceased estate. So they would get nothing. They do have a right to bring a lawsuit against the estate. But if you die without a will and a common law spouse, the money is going to your children, your parents, your siblings, somebody other than your spouse. People also don't consider the tax consequences of their plan. And that's the usual example of I leave the RSP to my daughter and I leave the rest of my stuff to my son, and you're not aware that the son has to pay the tax on the RSP from his share of the gift that he's made. Vague wills. There's a lot of, I think I might like to, or maybe give it to this person. My favorite one was when I got one where my executor didn't know any of the beneficiaries. They all had the last name Smith. So it wasn't vague exactly, but it was pretty similar in that they weren't identified. There's John Smith, Brad Smith. Anyhow, there was one name that was different, and he told me who all the Smiths were. They were cousins. Trustees. Everybody thinks that their trustees are going to get along, and that their children, especially if it's their children, and don't necessarily appreciate the dynamics that will happen. We would recommend, if you're going to have your children as the executors, that you provide a mechanism for resolving disputes. Incompetent trustees. These are trustees that are not good at following instructions, not organized, not timely. They're usually very nice people. They're just overwhelmed by the amount of work that has to be done, and they don't respond quickly or efficiently to what needs to be finished. Incorrectly named beneficiaries, that's the charity, for example, being the wrong name. No backup trustee. So you name your wife and she's the beneficiary. But you don't come up with what happens if she's not able to be the trustee because she's predeceased you or she's mostly incapable. And I often have multiple layers of trustees because, the typical one is spouse then kids. But I've been dealing with a lot of very small families lately. And so you have a spouse, one kid, and a grandchild that's a minor. What's going to happen if the parent dies? So let's talk about all the possibilities. No backup beneficiary. So I leave it all to my wife, I leave it all to my kids. But, we're all in one car accident. What happens then? Where does the money go? And then we put restrictions on right to deal with assets, which are unreasonable. And it makes it hard to deal with them. So those are the typical pitfalls that we see. There's been some really dramatic changes this year to the law on estates that happened in January. We still haven't seen how they are actually going to play out. As I said, if you die without a will, your spouse gets what's called a preferential share. It was $200,000 until this year. It's now increased to $350,000. So if you have a spouse so if you just have a spouse, everything that you have goes to your spouse. If you have a spouse and children, the split is now the spouse gets the first 350,000. And if there's one child, the spouse gets half of the remainder and the child gets half. If you have more than one child, your spouse gets a third and the children share 2/3. We have been doing virtual signings during the pandemic, and we're allowed to continue to do that. So I've done a lot of Zoom signings on wills. They're very clunky and the documents are very ugly, but they're legal. Bonds are required in certain circumstances for an estate. And they've now said that if the estate's worth $150,000 or less, no bonds will be required. The big change is revocation by marriage. So it used to be if you got married, your will was automatically void and you went into an intestacy will. And the big concern on that was twofold. One is, how do you tell your father that your new stepmother has now taken away your entitlements under a will without looking like you're greedy? But more importantly, people can get married at a very low capacity. And there was a fear that people would be walked off from the nursing home and get married, revoking the will and going to an intestacy situation. So, and anecdotally, that happened fairly frequently. So now they've said marriage doesn't revoke a will. They've also said, similar to what they used to say, that if you were divorced, the will was read as if your spouse had predeceased you. Now, if you're separated, the will is read as if the spouse is predeceased you. So there's some transitional rules in there. So if you're separated now, they don't have a separation agreement. There's a 3-year waiting period on that. But if you have a separation agreement, the will is read as if your spouse predeceased you immediately now. And then they've got this new substantial compliance that we don't really know what it means yet. We've seen it in other jurisdictions. But the example would be, you have a will and you say, I leave everything to my friend Jane Doe. And the testator has crossed it out and said, she's dead to me at the side. And that's the will that's presented for probate. In the old regime, that would not be allowed unless it was properly signed and witnessed like a will normally is. But now in this substantial compliance regime, it may be recognized that the will is read as if that's a valid deletion from the will. So we're waiting to see on that. And I look forward to your questions. And I'm sorry that this is virtual, because when I do it live, I send chocolates out if you ask me a question. So you'll have to imagine getting a chocolate. Thank you. I'm going to ask if Kathy is able to come back.
Well, thank you, Sue. That was a great legal overview, some really great tips. So now I'd like to welcome everybody back to the screen for our question and answer section. We have about 10 minutes left, and we have quite a few questions. So thank you. The first question that we have, Diane, I think this will probably be for yourself. What is a graduated estate or graduated rate estate, and how would an estate be deemed a GRE?
Thank you, Kathy. A graduated rate estate is, generally speaking, the individual's estate as a result of their death for the first 36-month period following their death. So if an individual's estate was complex and could not be wound up within a 36-month period after death, then it would, after 36 months, no longer be a graduated rate estate. But not only is a graduated rate estate considered looking at timing and how long the individual's estate has been around, but it also has to be considered a testamentary trust under the definition in the Income Tax Act. So there are certain transactions that can occur that could, in fact, result in the graduated rate estate or the trust losing its status as a testamentary trust. I think Sue mentioned a scenario of the child who was a residual beneficiary of the estate having to pay the income taxes related to the RIF that went to their sibling. Paying taxes, a beneficiary paying taxes on behalf of the estate would be a triggering transaction that would result in the estate losing its graduated rate estate or its testamentary trust status, and therefore not being a graduated rate estate subsequent to that transaction.
Thank you, Diane. That was a great response. This next one is for Terry. Terry, can a term insurance policy be gifted to a charity?
Actually, a term insurance policy can be gifted to the charity. The question is, what is the fair market value of that policy? Now, for those that don't know, a term insurance policy is exactly that. It's meant to insure someone at a specific premium for whatever the term is. Now, typically, these types of policies do renew and the premiums start to get high. They typically get very high. Really, the closer to death you are, the older that you are. And generally, these policies terminate before you do. So because of the fact that they terminate usually before death, they really don't have a lot of value to the charity. But if you have a term insurance policy and you've just been diagnosed with some kind of medical condition that your life expectancy, falls under the term length that the policy has, then the fair market value of that term policy could be rather significant. And that policy could have a fair market value and be donated to a charity with a good tax credit provided afterwards.
Great. Thanks so much, Terry. Another one for Diane. Diane, can I file the final personal income tax return for the deceased individual early?
I, in fact, never file a terminal return for a deceased individual early. Part of the issue really relates to the fact that there could be subsequent income tax changes right up to the end of the calendar year. And in addition, now that everyone uses software, Revenue Canada, in fact, does not approve that software until very early the following year. So they will approve the 2022 software in early January of 2023. They will not accept electronically filed returns. They do not start accepting them until usually mid to late February for the taxation year in question. So the answer is really no. It's in this computer-based society, there is really no ability to file early. And in fact, you still do not receive any of the required tax slips until February or March following the year end in any case.
Great. Thanks very much, Diane. Sue, this one is for you. My dad just remarried, and I know he left everything in his will to me. Will his marriage change anything for my inheritance?
Well, that's just what the new law says. It doesn't. If the will stays the same. The only issue is the new spouse may have claims against that estate. So the will itself will stay valid. It will be exactly as it was before your dad married. But your new step parent, because it could now be a boy or a girl, could bring a claim for what's called a dependents relief claim under the Succession Law Reform Act. So under that statute, when you die, you're obligated to provide for your dependents. And if you haven't done that, so your dad didn't provide for the new spouse, that spouse can bring a lawsuit to protect their interests.
Great. Thanks very much, Sue. Terry, this one is for you. What types of securities qualify for special tax treatment?
Well, just as a general rule, I can get very specific, but any security that's listed on a public stock exchange, a mutual fund, a segregated fund, a bond or debenture, a mortgage, all of those types of things. I can even include things like ecologically sensitive land or cultural products, that sort of thing can all go to a charity and benefit from the charitable receipt, and in many cases, the appreciated value of that item.
Great, thank you. Diana, another one for you. Why does it take so long to get an estate tax return assessed? When I file my own T1, I get the assessment back typically in a few weeks.
Thanks, Kathy. Typically, T3 or estate returns, CRA has only in very recent years started permitting those returns to be electronically filed. Any return that's electronically filed, it's generally a computer that's doing the assessment rather than an individual. But when it comes to an estate or a return or trust return, there are some significant restrictions on the scenarios where a trust return can in fact be electronically filed. One of those restrictions is if there's any income tax owing, and typically there often is. And so those returns cannot be electronically filed and must be paper filed. And as soon as you paper file, you then have to have an individual pick up the return and look at the return as part of the assessment process. And it just takes that much longer.
Okay, that's great. Thanks so much, Diane. So this concludes our question and answer portion, and I just want to thank all of our presenters. Some great responses there. So thank you again for joining us this afternoon. We hope you enjoyed the presentations and found them informative and helpful. As you can appreciate, an effective estate plan is a balancing act to ensure that it continues to be relevant for you, and consulting with your own professional advisor is a great start. If you have any questions about how to support LHSC in your estate planning, I would be happy to assist. So first of all, I'd like to thank our presenters for sharing their time and their expertise this afternoon. Next, I'd like to thank all of our donors for your continued support. And also thanks to all of our attendees for taking time today from your busy schedules. Thanks for joining us and enjoy the rest of your day.